All right, the AI gold rush is in full swing, right? But what if I told you the real winners, well, they might not be the folks writing the code. In this explainer, we're going to dig deep, I mean really deep, into the physical world that makes this whole digital revolution possible, and you might be really surprised by what we find.
We think of AI as this magical thing that just exists in the cloud. But the reality? It has a very real and honestly a very vulnerable physical supply chain. This quote right here, it just nails it. There's a huge bottleneck that nobody's really talking about, a resource crunch that could actually stop this whole AI revolution in its tracks.
And this number, this is exactly why we're all paying so much attention. This was NVIDIA's peak market cap. It's a mind-boggling valuation that shows just how insane the demand for AI chips really is. But, and this is a big but, this is only one tiny piece of the story. Okay, so behind that multi-trillion-dollar number, there's a physical cost that is just staggering. 26 gigawatts. That's the extra data center capacity that just one company, OpenAI, is planning to build. We're not talking about a simple upgrade here. This is a monumental expansion of real-world stuff. So what does 26 gigawatts actually mean? I mean, the scale of it is just hard to wrap your head around. To put it in perspective, that is the same power output as about 26, yes, 26 full-scale nuclear power plants. That's enough electricity to power almost 24 million homes. We're talking about an energy appetite the size of entire cities, all for just one player in the AI game. It's wild. So yeah, you can pretty much forget everything you've heard about AI being this weightless, purely digital thing. The truth is, AI is a business of atoms, and it is smashing headfirst into some very real, very hard physical limits. Its success, it depends entirely on power grids, massive amounts of water for cooling, and a ton of physical construction. And that brings us to this fundamental conflict, this thing we're calling the AI power paradox. Here's what it is. AI tech is moving at this crazy exponential speed, right? But the physical stuff it needs, the power plants, the transmission lines, that stuff moves at the slow, steady, linear pace of the real world. You see the problem? This timeline just lays the problem out perfectly. I mean, just look at how long it takes to get one new nuclear power plant running. The application review alone can take 5 years. Then you have another 5, maybe 10, sometimes even more years for the actual construction. You can dream up a new AI model in a few months, but you can't just snap your fingers and build the power grid for it. The timelines are completely, totally out of sync. So if you really want to invest in the AI boom, you gotta look beyond the chips. The real and maybe the most overlooked opportunity could be in the companies providing all this essential infrastructure. We're talking about copper miners, uranium producers, the power utilities themselves who are just scrambling to meet demand, and all those specialized companies that are physically building out the data centers. So how do you actually go about investing in the physical guts of the AI boom? It's not as simple as just buying a bar of copper, unfortunately. In this section, let's break down the financial tools you can use to get some exposure to these really long-term commodity cycles. First things first, we have to understand the basic building block of these markets, the futures contract. The old analogy of the baker and the flour producer explains it perfectly. One guy is worried the price will go up, the other is worried it'll go down. So what do? They agree on a price today for a delivery in the future. Bam! Both sides have just eliminated uncertainty and managed their risk. And that simple handshake agreement, it's the foundation of a multi-trillion-dollar global market. Okay, contango. It sounds complicated, but it's a really important idea. It's basically when the future price of something is higher than the current price. Now, for investors in funds that use futures, this can be a disaster. It means the fund is constantly having to sell its cheaper, expiring contract to buy the next one, which is more expensive. This constant rolling over at a tiny loss, it's like a slow bleed that just drains the fund's value over time. Now, backwardation is the complete opposite of contango, and it's often a massive flashing red light that there's a supply shortage happening right now. This is when the current price, the spot price, is higher than the future price. The market is basically screaming, I'll pay you a premium to get that stuff immediately. For investors who are long the commodity, this can be a very, very profitable situation. If you want a brutal, real-world example of the contango crush, just look at a fund like UVXY. Because it's almost always forced to roll into more expensive future contracts, its value is practically designed to go to zero over time. This chart is such a powerful lesson. You have to understand the mechanics of how a fund is built. It's just as important as being right about the direction of the asset itself. So, what if you want to avoid all that complexity with futures contracts? Well, you can invest directly in the companies that actually produce these commodities. But the second you go down that road, you're faced with a big choice between two totally different kinds of companies, and each one has its own risks and rewards. And this slide really breaks down that fundamental trade-off. On one side, you've got the major producers, the big, established, large-cap giants. They're financially solid, lower risk, but, their sheer size means you're probably not going to get explosive growth. Then you have the junior miners. These are the small, often unproven exploration companies that have the potential for those lottery ticket returns, but with that comes an absolutely huge amount of risk. But hold on, before you go and pour your money into a small cap mining stock because you think you found the next big thing for the AI grid, there's a critical and, frankly, very sobering piece of wisdom you absolutely have to hear. A lot of investors make this one fundamental mistake. They think that buying a tiny mining company is the same thing as buying the copper it hopes to dig up. Let me be clear, it is not. It's not even close. And believing that, well, that can be a very, very expensive lesson to learn. Legendary investor Charlie Munger, who was never one to soften the blow, had this famously blunt warning for anyone thinking about playing in this sandbox. And look, this isn't just him being cynical. It's a really profound observation about the massive operational and human risks that are just baked into the mining business. This is the key takeaway right here. When you invest in a junior miner, you are not buying copper. Let me say that again. You are not buying a claim on the metal in the ground. What you are actually buying is a bet. You are betting on a management team's ability to navigate geological reports, endless government permits, and tricky financing, all in the hope that they can turn that hole in the ground into a profitable business without going broke first. And this quote just illustrates the point perfectly. As author Christopher Mayer wrote, the potential for those huge, life-changing 100x returns, it doesn't come from the commodity. It comes from finding the right alchemist, the right management team that can somehow turn raw dirt into real profit. Your entire investment really just hinges on a bet on people. So the AI revolution is definitely here. The question for you is, how are you going to invest in it? Are you going to chase that fleeting digital gold that gets all the headlines? Or are you going to bet on the enduring value of the physical picks, the shovels, and the raw power that actually make it all possible? The choice is yours.